Welcome, everyone. I'll start by introducing myself. I'm Severin, Chief Commercial Officer at Enery. Enery itself is a fully fledged IPP with operations in almost all Central European countries. We have an extensive operational portfolio of wind, PV, and storage assets in Austria, Czech Republic, Slovakia, the three Baltic countries, Slovenia, Romania, Bulgaria. Today, with my colleagues, we will try to identify the key PPA trends that we observe, what we expect going forward, what are the off-takers' preferences, what are the PPA structures currently under discussion, and what is the best way to address the needs of the corporates and utilities with interests in long-term off-take agreements. So Carolyn, you want to go next?
Sure, thanks, Severin. I'm Carolyn Addy. I'm head of commercial at Renewabl. We are an expert-led digital advisory and platform for impactful energy procurement. I'll be looking at what the proposed GHG Scope 2 updates really mean in practice, how hourly accounting ties directly to hedging effectiveness, and the commercial implications for buyers. I'll also share some examples of how leading corporates are using data visibility to strengthen both compliance and procurement decisions. Niall?
Thanks, Carolyn. And yeah, thank you all for joining us here today. So I'm Niall. I'm the corporate energy analyst at BloombergNEF, which is essentially a research house that covers all aspects of the energy transition. And what I mainly focus on is that kind of intersection between corporate sustainability and the energy transition and power markets. A lot of what I do looks at corporates, PPAs, and other forms of corporate clean energy procurement globally. As you probably kind of saw in a sneak peek, but at BNEF, we essentially track offsite corporate PPAs globally. And what we've seen in a European context is that European companies have grown hungrier for clean power. But before we kind of go into that world, at BNEF, we also have a tool that looks at RE100 members and then forecasts their electricity demand and their clean electricity demand up till 2030. So that's essentially corporations that have pledged to use 100% renewable electricity on an annual basis. And in Europe, there are approximately 150 of such companies. And by 2030, we estimate that these companies will be responsible for 51 terawatt hours of clean electricity demand by then. And that's roughly equivalent to Greece's total power generation in 2024. That number is also most likely an underestimate if we start including other companies that have other corporate sustainability commitments like Scope 2 emissions reduction targets. But in any case, one of the most impactful forms of corporate clean energy procurement is via the route of an offsite PPA, as it has high additionality. And what we've seen over time is that more and more markets have opened up to across Europe to host corporate PPAs. So it's roughly 27 markets so far in Europe, with over half of those opening up since 2021. So it not only goes from some sort of mature markets activity where it has proliferated thanks to some EU mechanisms like Repower EU, across smaller markets, predominantly across Central and Eastern Europe. And what that means is that essentially we've seen corporate PPA volumes grow significantly over time. Especially we've seen some consecutive back-to-back record years in 2023 and 2024, where we tracked over 17 gigawatts of clean corporate PPAs across Europe, with, of course, the main market being Spain, but then a lot more activity when we start looking at that light purple bar at the top. A very quick statement on 2025 is that we've monitored slowdown in corporate PPA volumes so far through October 2025. A lot of that is largely due to rising power market volatility, but also tighter profit margins, which makes both buyers and sellers kind of take a step back and reassess new corporate PPAs. But in any case, the diversification in markets has also contributed and has been supported by a diversification in off-taker types. So you'll notice in Europe, of course, big tech is the biggest off-taker type, not only in Europe, but also globally. But in Europe, there's also a very big customer base from materials companies like chemicals firms or construction materials firms, but also industrials and manufacturing companies, which are also quite prominent drivers of corporate clean energy procurement across the region this year. Similar to the markets, we see this kind of light purple bar where we see also newer types of off-takers or smaller types of off-takers buy clean power, and these can be communications companies or healthcare firms or even retailers. But like I mentioned, and like we saw in those charts, there has been some unprecedented volatility, which has made market players pause. So the big kind of topic of the moment, which has been on top of mind for a lot of players, is negative power prices. So this only shows instances of zero and negative power prices across some key European markets up till 2024. But what we've seen already during that period is that there was an near eightfold jump, for example, in Spain, and a significant increase also in other markets in France. And negative power prices essentially increase the risk of not only curtailment, but also can be indicative of a market that faces grid congestion, which are all key risks that can hinder the negotiation process towards the procurement of clean power. And a very quick update, if we then dive a little bit more into Spain for this year, is that what we've seen is there's been an increase in strictly negative power prices. So that also will have some ramifications towards a negotiation where you're considering either a zero price floor or actually thinking of how to hedge against purely negative power prices. In a Spanish context, a lot of that can actually be attributed to what happened with the grid blackouts, where gas generation then increased following it, pushing prices more into that negative territory. But in any case, these instances are much more common now across Europe, which becomes a very key risk for both buyers and sellers to consider when they're procuring power for a duration of 10 to 15 years. And we stick to the Spanish context. We have seen also merchant revenues, especially for solar, dip to record low levels in May 2025. And that's also accompanied by greater power market volatility. So we're not in that paradigm of what we've seen in post-energy crisis in 2022, with very high power prices, which reinforce the business case for PPAs. This is a bit of the opposite, where realized power prices are going down, meaning that there's less of a case for buyers to then contract a long-term PPA at a fixed price if they can purchase it at a lower price. But then again, there's always the consideration of volatility. From a seller's point of view, essentially, what that means is that we go from a high PPA price regime to a low PPA price regime. And that means, from at least according to our earliest corporate PPA price survey for PPAs assumed to be signed in 2H 2024, we assume that those PPAs then, compared to the solar LCOE in Spain, are facing tighter margins, meaning that sellers are facing more struggle to make profits from their PPAs. As we head into not only 2020, as we finish off 2025 and we head into 2026, and as renewables adoption and deployment continues to grow, we expect that trend to continue being the case for standalone solar, but also onshore wind PPAs. And so this then creates that uneven momentum that we've seen across Europe, where, for example, we see a slowdown in the Spanish markets, we see a big slowdown in Germany, but then there's still an increase in some other markets like Italy or other Eastern European markets like Romania and Poland. But also what that means is that there's an appetite that's growing for clean, firm power across Europe. So at BNEF, on top of tracking standalone solar and onshore wind, we also track other types of clean power generation sources that provoke baseload-like power. So that can include hydro, biomass, geothermal, nuclear, but also by artificially creating such profiles through either hybrid PPAs, solar and wind, or co-located solar and storage PPAs. So what you'll notice here across Europe is that the hybridization through solar and wind is kind of a more prominent choice in the European corporate PPA market, but we're also seeing some greater appetite for those clean baseload sources, not only just hydro, but also we've seen the first off-site nuclear PPA in France and Europe through the French CAPEN mechanism. And we've seen, so that means that we've seen a record volumes of such deals being announced through the third quarter of 2025. But Europe still has quite a bit to learn from the global market, as it is roughly a tenth of the clean firm power options that were signed globally. So globally, what we've seen is also another record year of such deals being announced, with solar and storage being more prominent in other markets, interestingly, like Egypt or Australia. And then nuclear kind of making its big appearance in the US. So this kind of greater power market volatility essentially is already pushing both buyers and sellers to sophisticate rapidly as they move from procuring from standalone sources and intermittent renewables to kind of hunting for baseloads like power. Carolyn is going to touch on this very quickly also later on, but also as the GHG protocol conversations around Scope 2 carbon accounting guidance is underway. At BNEF, we've been thinking around how do we kind of reframe impact, not only from considering additionality, but also the carbon impacts of PPAs through the lens of emissionality, which would be more aligned with consequential accounting as per the future updates. And at BNEF, what we kind of consider emissionality through is essentially as a multinational, if I have operations a bit globally, how can I kind of rethink my corporate clean energy procurement from not only looking at how can I add that extra clean megawatts, but also how can I then offset or displace the most emissions. The biggest example again is Spain, where adding an extra megawatt through just purely additionality may not completely support grid stability. So what we've seen from PPAs being announced between 2013 and 2024, and then expected to be commissioned by 2030, is that corporations will help displace at least 300 megatons of CO2 by that time, at least within the first year of their operations. And a lot of activity has been concentrated in the Americas, especially in the US, but then we see a lot of that future growth coming on in Asia Pacific. In EMEA, at least from the PPAs that have been announced so far, we expect the impact to kind of peak this year and then kind of gradually slow down in the next few years. But in any case, I think for us, it's really trying to think of not only from the volumes of PPAs that are announced, but also how these PPAs actually contribute to displacing emissions from the grid. And what we see then is that there are two strategies that emerge. either buy a ton of clean electricity, as you can see from big tech, especially Amazon, buying 45 gigawatts of clean power, but also by being a little bit more focused on those dirtier markets. The key example here would be mining company Rio Tinto, which has signed most of its power in very carbon intensive markets like Australia, Madagascar, and South Africa. So that means you can still add the extra megawatts and then also maximize your grid's decarbonization impact in those dirtier markets, which we believe would be relevant, like I mentioned, for that consequential accounting piece for the GHG protocol updates. Thank you so much. And I'll pass on now to Severin.
Thank you. Thank you, Niall. So I will follow up by reconfirming the observations already shared. A pure fact is that the PPA volume in 2025 decreased materially from a year before, mainly due to the reasons outlined earlier. And this is especially the case for the pure PV PPAs. The number of negatively priced hours and the constantly decreasing capture rates for solar made all the potential corporates much more careful when negotiating a PPA. And of course, their expectations and their preferences shifted from pure as-produced PPAs to more baseload-like or profiles that better match their consumption profile. Another key trend is that we see the big utilities or the big wholesalers coming back to the equation. We saw them being very active in the first half of 2023 and late 2022 when prices were extremely high. At that time, also we at Enery managed to close a few PPA with big utilities. Now we see their activity picking up, mainly because of the expectations of the big corporates. Now there is a demand for more structured products in terms of profile segregation, adding flexibility to any PPA structure requires a more sophisticated work that the utilities are experienced with. So from that perspective, we believe that on one hand, it is true that the constantly increasing number of negatively priced hours, especially during the PV production, more or less hampered the liquidity of the PPA market in Europe. But on the other hand, this provided a clear investment signal for storage facilities. And we expect that in the next 2 years, especially in Eastern Europe, where the development process is much more straightforward, I would say, compared to Western Europe, the deployment of storage assets to significantly outpace the deployment of new renewable generators. What I will do with the next 2 slides is to run overview through our PPA journey and share a few words on different timing of closing these deals. As I mentioned in the very beginning, late 22, early 23, at that time, the utilities were, I would say, the main off-takers in the market. So companies with sufficient credibility who at that time were able to provide 7 to 10-year tenors for PPAs, even in less liquid jurisdictions such as Romania and Bulgaria. So here on the slide, you see that the first 3 PPAs that we closed were exactly with utility companies. Afterwards, things changed. Volatility settled down together with the wholesale price. So from mid-2023 onwards till, I would say, first half of 2025, the PPA market has been dominated by corporates. At that time, at Enery, we managed to close deals mainly with companies operating in the automotive sector, but also telecoms and other breweries active in Central Eastern Europe. Nowadays, as stated earlier, there is a clear shift. So there is a strong preference for renewable baseload products from the corporates. And there is now a race between the renewable developers to structure the directly green baseload product, or to be able to structure something that is as close to the consumption profile as possible. I will give later on 2 case studies of PPAs that we structured and how we aggregated different technologies and different profiles to address the needs of particular consumers. In a nutshell, so both from the perspective of green certificates, guarantees of origin, but also generation profile, clearly there is a high demand of products providing a match between consumption and generation. And with the extremely fast deployment of batteries, the most of the efforts are exerted in aggregating PV wind plus some flexibility from the storage, and to find the best way how to share the benefits from the different technologies with off-takers. It is a good sign that we see also the big tech companies with interest not only in Western Europe, but also looking now seriously into our markets, mainly the Central Eastern European ones. There are a few general expectations that the hyperscalers have. First, it was already mentioned, the additionality concept. So they are mainly focused on greenfield projects coming online in the next 2 to 3 years. Then is the stability in the regulatory and legislative framework. This is especially in relation to the guarantees of origin and the transferability of the GOs. There are still some markets, even EU ones, where there are complications in freely transferring the GOs from the generator to the end consumer. In terms of the preferences of the hyperscalers, we can divide this into 2 sections. The first one we would say is the ESG-driven PPAs. So these are long-term offtake agreements enabling the construction of new renewable generations without a consumption from the buyer side, meaning that there is no plan for a data center, or there might not even be a presence of the off-taker in the respective jurisdictions, but it is purely ESG driven. Next to that, and especially in the more liquid market, we see demand for green electricity that is particularly driven by a data center investment in the same market. There, we have another set of requirements where hourly matching also plays a big role. But also in such a case, there should be a match between the COD of the consumption facility, data center or others, and the expected commercial operation date of the renewable generation facility. Then, very briefly, two recent examples of what we've done as Enery. The first one is a 15-year deal that we secured with Teva Pharmaceuticals. It is a PPA covering the needs for renewable energy in their facility in Bulgaria. There, from the very beginning, it was clear that the off-taker would like to somehow incorporate the flexibility of a co-located BESS storage into the PPAs. So we end up with securing 60 gigawatt hours of power per year for 15 years. But on top of that, there is a clear mechanism within the PPA where we share the benefit of the best technology. It doesn't mean that as a generator we are stick to certain charging and discharging timeframes throughout the full tenor of the PPA. On the contrary, the best can provide also ancillary services, so AFRR, MFRR, in case the TSO needs such services, but all the benefits coming from this are shared between the operator or the seller and, on the other hand, the consumer. Nowadays, we are in discussion with 2 or 3 other corporates where we are exploring different mechanisms of how to contract both renewable generation power from wind or PV assets and co-located BESS. Then finally, I would just say a few words on a deal that we closed with Orange, the French telecom, and these PPAs to cover their consumption in Romania. It was a bit complex deal where we needed to aggregate profile from a PV plant located in a neighboring country and also wind asset being operational in Romania. So a key concern of the off-taker was related to the capture rates, and a key requirement from their side was to either have a threshold on the capture rate or try to come up with something that is closer to baseload. So the only way to address all these needs at the time was to use an operational PV in Bulgaria. So on one hand, we managed to close the first cross-border PPA between generation in one country and consumer in another one. And on top of that, add up some wind energy to balance the aggregated product from both technologies. And this is what we expect to shape the future PPAs, especially in terms of different generation profiles And we expect that the most successful IPPs would be the ones who are best equipped to use flexibility or best assets into their offerings. So then I would give the floor to Carolyn to continue with their observations on what is shaping markets and compliance in the years to come.
Great, thanks so much, Severin. So now I'm going to cover a bit more on some of the forces driving some of the challenges we hear about from corporate buyers, and hopefully I'm going to make both of these feel a little bit more manageable and give you some practical ways to think about next steps. Just a bit more on what we do at Renewabl. So we help buyers track consumption, procure renewable energy via PPAs and certificates, and reconcile everything at an hourly, monthly, and annual level. Sorry, hourly, monthly, and annual level. That foundation is what makes Scope 2 accounting and procurement decisions much more straightforward. We sit in the middle of the ecosystem, so alongside buyers, sellers, and partners, and we try to make the entire procurement chain more transparent, more efficient, and more credible. Niall and Severin have already given us some great insight from the sellers and partner perspective. I'm going to focus a little bit more on what we see on the buy side. So these are some of the themes we hear occupying corporate procurement and sustainability teams' worry lists. And as you'd expect, there's quite a few, but market volatility and legislative uncertainty are usually at or near the top. So we wanted to dive into those a little bit more. If we start with the GHG Protocol Scope 2 update itself, this is the timeline published by the technical working group. So we've got the phase 1 public consultation, which is happening now, deadline in December. So we would very much encourage all market participants to take part in that consultation. And then we'll move into a phase 2 review in early 26, followed by another round of public consultation in Q2, Q3. The expected final standard currently is back end of 27. Obviously that timeline might change. What I think is really interesting here is the intent behind the proposed changes. So the updates are aiming to improve transparency and credibility of corporate renewable energy procurement, strengthening environmental impact gained from that procurement, but also keeping things feasible to implement. So helping corporates particularly manage this transition. The main changes in the proposed updates are a move towards hourly and geographic matching for market-based claims. So this essentially means evolving from the existing accounting system, which allows, for example, energy generated at midday in Spain to be used to claim renewable energy coverage at night in Germany, which most people agree doesn't really make sense. There's also a suggestion of a marginal emissions impact as a complementary metric. Two really important points are the GHGP update doesn't itself propose any specific hourly matching targets or procurement strategies. And also with an eye to this feasibility point, there are proposed allowances for phased adoption and grandfathering clauses, etc. So the most common question we get from buyers is what's that gonna cost me? And crucial point, as I said, Killian Daly, one of the technical working group, makes the critical point really clearly. The update won't require any companies to be 100% 24/7 carbon free by any date. This stage is really about getting your ducks in order for hourly accounting, not hourly matching from day one. There is a lot of discussion going on at the moment around the proposed updates, partly because the consultation is out at the moment. For anyone who wants to kind of dig deeper, we've had some great discussions recently with Killian and others, both on the Plugged In podcast and at Renewabl Day. So feel free to scan the QR codes after the session for the materials, or of course, myself and the rest of the Renewabl team are happy to chat it all through with you. So if we think about what it's going to cost in the short term. So at the moment, in terms of cost, it's mainly about time and data management. So you'll need to start getting hourly generation data from your suppliers. Then you want to pull in your demand data. And obviously here you'd want to look at using smart meters wherever possible. And then you need to reconcile both, either manually in spreadsheets, etc., or through a platform. So to be clear, short term, it's about data management and visibility, maybe less so about kind of actual target setting. If we look a bit further on, is it going to raise costs in a bit so kind of longer term? So studies like this one from the IEA show something quite interesting, that actually with good data and the right tech mix, up to 90% hourly coverage might be achievable at a similar cost to hourly matching and annual matching. Now, obviously, that does depend on your demand profile and the solutions available to you in your market, but it's an interesting point to start from. And then the last 5 to 10% is really where costs rise. And to achieve that, you'll likely need to look at storage or demand flexibility. I think it's also worth noting here that it remains to be seen what good is going to look like in terms of setting hourly match targets. It's possible that 80 or 90% hourly match is going to be seen as very good when we move to this kind of new dynamic. So moving on to the second big topic is market volatility, which we've covered a bit before. Negative prices, cannibalization, huge swings in spot markets. This is the reality for PPA buyers in Europe, which of course creates a lot of internal challenge for long-term procurement and risk management strategies. Now, a hedge, like a PPA, is a straightforward concept I'm sure you're all familiar with. You lock in a price. The aim isn't to earn money, it's to give you confidence in what you're going to pay. So whenever the market price goes above or below your agreed line, either you pay the seller or they pay you. And the outcome should be predictable cost. However, sometimes we forget that electricity markets settle hourly, not annually. So if your supply only covers certain hours, like solar in the middle of the day, you're hedged in those hours only. So fundamentally, unhedged hours, you're going to have to buy at spot, and that creates an exposure. And then where you have excess hours, you're potentially selling into those low or negative prices we've talked about before and creating a loss. And that's why many buyers have discovered some unexpected losses in the last couple of years. This is an interesting example from Finland in a recent Eurelectric report. A buyer with a solar, wind, and BESS strategy could have saved 14 million euros in 2022 because their hedge covered more hours of volatility. So there was a small loss in 2020 when market prices were low, but as prices and volatility increased in 21 and 22, the position was reversed and the 22 saving dwarfed the loss by about 10 times. Paul Hill, our head of energy market, spends a significant amount of time talking with clients and analyzing these dynamics when they're in the PPA process. So, yeah, happy to carry on that discussion if anyone would like to. I suppose the big message we want to leave you with on this piece is that hourly matching effectiveness also means hedging effectiveness. How does that really work in practice? So essentially, better hourly matching or stronger 24/7 CFE score means fewer unhedged hours, less exposure to the volatile spot markets, more stable, predictable cost outcomes. So essentially what we're saying here, that the same products that reduce your volatility risk, for example, hybrid PPAs, baseload PPAs, they also strengthen your Scope 2 claims. So both your reporting needs and your need to manage volatility in markets both win. Again, from the same Eurelectric report, analysis suggests that depending on your market and demand shape, a combination of solar and wind often gets you into the 60 to 75% hourly coverage range. But you can see this only once your data is reconciled hourly. So otherwise, you're flying blind without the underlying data on which to make these kinds of decisions. So what if one platform could support with all of these challenges? So that's where we like to help our clients. So we have Renewabl Track, which pulls all your clean energy data into one place. So your consumption, supply contracts, certificates, and provides annual, monthly, and hourly matching metrics. This is alongside renewable trade, which enables you to actually execute your renewable strategy with visibility over hourly coverage, hedging strength, and fit to your demand curve. So together they give you one coherent view from strategy into procurement and compliance. Most buyers today don't have this end-to-end view, and that's where a lot of the value gets lost. One of the biggest gaps we see in the market is the lack of alignment between PPA proposals and a buyer's real demand shape. So what you see here is exactly what happens in tenders every week. Developers offer volume in hours that don't match your shortfall. So on the left, you can see significant undercoverage in the hours where the buyer actually needs protection. On the right, a second proposal covers different hours, again, not necessarily the ones that matter. Renewable trade overlays your actual demand curve onto every proposal. So instead of picking a PPA based on an annual megawatt hours number, you can choose based on which hours you're hedged in, where the gaps are, and what kind of exposure that leaves. And this is where hourly matching and hedging come together. I'm going to very quickly run over a few case studies. So this first one is a global consumer goods company. So they already had 100% annual renewable coverage via a mix of PPAs, GOs, and on-site generation, but they had no visibility on their hourly carbon-free energy position. So this meant they couldn't really understand their actual performance or prepare for the Scope 2 updates. So the goal was simple: measure the performance on an hourly and monthly basis and build readiness for regulatory changes. With Renewable Track, they uploaded demand and generation data, allocated certificates, and for the first time saw their true hourly CFE score. So they moved from annual averages to this hourly transparency, from high-level assumptions into verified insights, and then also high-level reporting to auditable regulator-ready data. They now know exactly which hours are exposed, where procurement needs to evolve, and how to prioritize improvements. And this is the foundation for credible reporting under the proposed Scope 2 updates. The second example is a European data center operator. So a few factors made this urgent for them. They were expanding very rapidly. They had national recognition as a clean energy leader. Their clients demanded transparency, and they were seeing signs that that was only going to increase, and they were preparing to sign another PPA. And the challenge was really to answer two questions: how clean is our energy hour by hour, and how is our PPA actually doing what we think it's doing? So with the platform, they were able to move from annual matching to hourly renewable accounting, strengthen their appeal to customers demanding transparency. They also built a compliance edge ahead of EU reporting changes, and they could verify real carbon reductions linked to their PPAs. This gave them the confidence to move ahead with their next procurement cycle with a clear view of performance and gap. Before I close, just a quick note on methodology, because credibility matters here. So we calculate an hourly CFE score using contracted clean energy and your actual load, only including default grid mix where specific criteria is met. And this approach is aligned with the direction of the GHG Protocol and emerging 24/7 standards. At the same time, we also calculate for clients their emissions-based metrics, looking at total avoided and net grid emissions. We do have a methodology paper on our website for anyone interested in reading more detail. And I will just leave you with three main takeaways. So the GHG update is about hourly accounting, not mandatory hourly matching. So you will need to show how your demand lines up with procurement on an hourly basis. Better hourly cover is a better hedge. So hourly coverage strengthens your risk management and reduces cost exposure. And then probably first place to start is visibility. So you can't act on what you can't see. Hourly data is the foundation for Scope 2 compliance and smart procurement. So if you get these three pieces right, the transition is going to be a lot easier. And that's it from me. So thanks so much for listening. And we'll now move on to questions. Niall, Severin, and I are available. I think we'll maybe take these in the order that we presented. So maybe Niall, do you want to jump in with the first one?
Yeah, definitely. So I got one, I guess, double question, which is around the view for 2026 on PPA prices, but also PPA volumes. So in a nutshell, I think we expect that standalone solar and onshore wind PPA prices will remain low across Europe. But also at the same time, we expect prices for hybrids, so solar and wind and co-located solar and storage PPAs to fall, especially as battery costs fall very rapidly. I want to also reiterate that this will really very much depend on the market. So some markets like Italy will have higher PPA prices, and that's why we've seen quite a big jump in activity in the past 2 years in that market. And similarly in Romania, it has an interesting dynamic between the CFD prices, the PPA prices that we see in the market, and the wholesale power price. But in any case, as power price cannibalization continues and renewables deployment continues to increase, we expect PPA prices to follow that trend. When it comes to volumes, I think that will depend a lot on external factors, and one of the big ones is around regulation. So there are some EU regulations that are out there which may or may not encourage further corporate PPA adoption. So the two main ones are the CSRD, and that will basically be very much dependent on the number of in-scope companies that have to start reporting on their corporate sustainability matters, but also the Clean Industrial Deal through the EIB's counter guarantee scheme, which should hopefully encourage further adoption from small energy users.
Perfect. Thanks, Neil.
No worries. Yeah, I'll leave the next question, I think, for you, Carolyn.
Or Severin, would you like to go next?
Yeah, I will first start up on what Neil just shared, and I agree with what was explained in terms of the difference in the different jurisdictions and how the CFDs coexist with the relevant PPA markets. Usually, the CFD we consider as a support to the relevant PPA market, given that the corporates will need to choose usually from the capacity that is left after bidding on the CFD, and this is exactly the environment we see in Romania. On the other hand, we need to also consider the deployment of storage assets, especially in the region of Eastern Europe. So Greece, Bulgaria, Romania, Hungary, the four markets are pretty well interconnected, but we see projects for standalone and co-located BESS in the amount of 15 to 20 gigs coming online in 2026, so by the end of next year, which should definitely bring some level of stabilization in the PPA prices. I agree that the pure as-produced PV or wind PPA are very hard to get now, but with the BESS coming online and the fact that the grid capacity is limited, we do not expect to see further decrease in the PPA prices.
Thanks, Severin. Did you want to choose another question, or shall I jump in with one around data?
Yeah, please go ahead.
Sure. So someone's asked, what are the data inputs you see corporates using for hourly accounting, and what data do we actually need to get started with this? So yeah, so I mean, essentially we kind of covered it, but it's essentially so your demand data. So you need to get a clear view of your consumption data from suppliers or smart meters. So we often help with corporates setting up the comms flows there. So looking at where they're housing data currently, or are there data flows that can be tapped into between a supplier and the customer, etc. So looking at that on the demand side, and then looking at your supply on an hourly level. So PPAs, you should be able to get hourly generation data under any PPA. For unbundled EACs, it can be more difficult. If it's linked to a traceable asset, that's often more likely, but potentially where there's more intermediaries in an EAC process, it may get more difficult. That is where there is some allowance in the protocol update for potentially using proxy data for hourly data there. But the principle is that where data is available at an hourly level, we should use that accurate data. Something we do also see is even for clients who aren't necessarily looking at hourly matching at the moment, often clients don't even have their renewable energy coverage all in one place anyway. So the platform can be used for that. So just being able to have one clear view of all your renewables coverage across global portfolios can be really valuable. Just having a look at the other questions.
There is if you have proceed with the last one and the one before. So on the tenor and terms of a PPA based on the different tenors. So what we see is that the shorter term tenors are priced slightly higher, but from a bankability perspective, the developers will need to be much more creative to come up with attractive project financing. Usually, especially for Eastern Europe, what we see is requirement for a minimum duration of at least 7 years for a product or a PPA to be considered bankable. In more Central to Western Europe, we have also observed shorter term deals like 3 and 5 year ones. But again, at least in my personal opinion, it doesn't make much sense to go with the immaterially higher price for a shorter duration, but put the bankability at risk. On the volume side and whether we expect big offtake deals in 2026, I still think that this is definitely to come. Most probably this would not be as produced deals, but definitely the volume is picking up at the end of 2025, and we believe that this will persist also during 2026. There is a clear demand for more structured products, for baseload or close to baseload profiles. So we also see big projects under development, like 500 plus megawatts of PV and wind. This is what we believe would shape the markets next year. So definitely a smaller number of deals, but with significantly higher volume. Neo, sorry, I saw that you started typing an answer on one of the questions. Maybe I interrupted you.
No, of course. Maybe just to build on that point around shorter term deals. So like I mentioned at BNEF, we track publicly disclosed corporate PPAs. And what we noticed in Europe and what we wrote about in our latest corporate energy market outlook is that on average, the average PPA term length in Europe is around 12 to 13 years. So we don't see a lot of those 5 to 10 years, 10-year deals being announced. And more often than not, also such shorter term deals will be for repowering assets. So repowered wind farms, for example. So that could be potentially an opportunity for buyers to look at the rise of repowered assets that are set to be repowered, as this is where more likely than not developers would be able to accept shorter term deals.
Yes, thank you all. I believe that it was a very productive discussion. Thanks for the participants and the questions raised, to the panelists as well. And yeah, it was a pleasure. Thank you so much all.
Thank you so much.
Thank you.